Hello and welcome to KBRA Clips. I am Kate Kennedy and I head our media relations efforts, and I'm joined today by Mark Berry, Managing Director and Head of KBRA's REIT Group. Welcome, Mark.
Thanks, Kate.
So since you joined us a few months ago, you've been putting out some great research, including your most recent piece titled Private Placement REITs, Lower Leverage, Better Execution. This was a follow-up to the report that you put out in September. And just curious what the new enhancements are and the differences from the report in September.
The focus of the new report is REIT private placement issuers and execution, and potential advantages and disadvantages of private placements versus public offerings, both from an investor and an issuer perspective. And that first report introduced our methodology for deriving REIT unsecured leverage and rationale for doing so. And it was more limited in scope to REITs that have issued unsecured bonds in the public market. I think both reports are rewarding in different ways, and highly recommend people go back to the first report as well for a primer.
So what are the key takeaways that you're looking for market participants to take from the report?
I think the first is that REIT leverage is considerably lower than believed by many market participants, and covers a much wider spectrum as well. Debt to market is only 32% by our observations for public issuers, and it ranges from 13 to 65%. By comparison, the average look-through LTV for AAA CMBS conduit issued in the last several years was 46%. So unsecured REIT debt is considerably lower in leverage. The second is that leverage is even lower for private than public issuers. This was a bit of an unexpected finding in this report. Total debt to market was only 27% for the private issuers. And they also had about 80% of their total debt being unsecured. That suggests to us that they're just as committed to the benefits of being an unsecured borrower. Third, we think private placement issuers are being deterred from the public market by the large 300 million minimum size for inclusion in the Barclays Aggregate Bond Index. These companies, on average, the private issuers have about $1 billion of total debt outstanding. That 300 million would be 30% of total debt, and REITs generally want to avoid, as would investors, to have that much of a concentration in any one maturity. Instead, they've been commendably, I think, laddering with smaller private placements in the 50 to 100 million range.
Got it. Okay. So in the report, you also mentioned that private placement execution might be advantageous to REITs. How so?
First, KBRA sees public execution as advantageous for all REITs. It's a much larger borrower base. Borrowing costs are generally lower. REITs can use shelf registrations for overnight funding and to potentially price very opportunistically on either rate or spread. That said, private placements can offer far more flexibility for a tailored execution. And in several areas, we think surpass the execution in the public sector. First, private placements can be right-sized to match the company's funding needs. Secondly, they allow REITs to delay timing of actual funding by up to several months until proceeds are actually needed for new investment or potentially maturity refinancings. Third, private placements allow REITs to negotiate forward rate locks. And that's important, that REITs can really dial in the accretion and the relative spread between their investment yields and their borrowing costs.
Okay. So what would you say are the potential advantages for investors?
For buy and hold investors, the yield premium for REIT private placements may be more attributable to liquidity than to actual credit risk. In several areas, we think credit risks may be even lower for private issuers than public. One is lower leverage. A second is lower event risk. We think private issuers tend to follow more steady and predictable growth plans, less likely to maybe veer off course. The third is lower M&A risk. Private placements almost always provide protection against change of control, M&A, whereas only some public offerings and indentures do so. The fourth is that private issuers are actually growing total assets far faster than our public issuers. Our analysis is that private issuers are growing assets 4 times faster over the past 3 years.
Yeah.
Fifth, smaller and more frequent debt offerings should reduce companies' reliance on bank credit facilities and let them maintain a narrower range of leverage.
Okay. Any others?
The opportunity for investors to potentially negotiate even tighter covenants, although REITs do have what I would call the best covenant package of any corporate sector. It's hard to improve on, but there's areas. And the other is the opportunity for investors to add exposure to property sectors that they may not see much of, if at all, in either CMBS or the public unsecured market, by example, data centers and single-family rentals, where leverage is actually the lowest of any REIT sector.
All right. Well, thank you very much for that summary. And thank you for joining. Mark's research piece is on our website, kbra.com, and all of our research is free. Thank you again.